Welcome to another weekly market insight where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions, not incisions. It would be your father if we were doing incisions.
Yes.
But I have Chris here today with his marker, trusty. It's blue still. I'd like to get it to be purple and call him Harold.
Just trying to match you. Mine just doesn't change slides.
Yeah, it just does not change slides. So we had a big headline print today for, over the week for CPI, 6.8%. When we look back, we have to go all the way back to the early 90s to see anything as high as we saw on the CPI. So how is the Fed and their transitory call going at this point?
It's not working. And I think they're, like we've discussed in the past, they're maybe starting to lose credibility.
Yeah.
So they're probably unlikely to keep going back to, well, we'll look at core inflation and that's only 4.9. Or we can remove even more numbers and it's only 4.1 if you get rid of housing and used cars. So they're probably unlikely to do that.
And they just removed the word transitory and they said they're retiring it, and it was not because of victory, even though that's what they're claiming. So let's look at the actual inflation, or the heat map. This comes from the Bank of America Merrill Lynch organization. And whenever they put this together, I'm pretty sure the person put it together as left-handed, not right-handed. And they have different colors that I would use. So I would do it exactly opposite. But if we start over in December 2020 on the far right side, we can see that looking back a year, it was 1.36, and then we get all the way up to this November print of 6.8%, and we can see green is basically high inflation, where red is negative inflation there. So it's a little bit backwards, but we can see that how inflation has moved up. Now the question is, are we going to start seeing it actually come down? And they talked about the base effect, and I don't think that's going to be the case, because if we look on a month-to-month change, still the same color coding. We go back to December where the month was up 0.24, and here we are November 0.78, and we can see most of that red is further out. So each month that we tick away, we actually are losing a lower value in the way that we're calculating the change over the previous year. So that base effect that was constantly talked about actually is now working against them. So if we just...
I was just going to say, and they're annualized monthly numbers, so 0.7 times 12 to
right.
get to, because 0.7 doesn't seem like a lot when you just say inflation was 0.7 for the month.
No, but it would be great if we could actually achieve 0.7 return every day in our portfolios. Yeah. We would basically own the world pretty quickly, because it does add up. But if we're looking at just what would happen if we had a 0.2 month over month change, all the way to a 0.4, we could see that we have not seen the highest inflation headlines as of yet, unless we have negative numbers. So we're going to continue to see CPI headlines increase until probably March, and that's assuming that we start to see lower numbers from here, which is an assumption that I don't know is a great one. But I do think that prices are probably going to slow. We're not going to have as much of the rush. Now, Bill Ackman, still talking his book, had pointed out something that we had pointed out previously, which is when we're measuring CPI, we have this rent equivalent component in there, and it makes up a large part of the inflation index, which is basically a survey of individuals saying, hey, if you would rent out your house, how much would you charge? Not very scientific. We actually have better data, and I think the takeaway here is it wouldn't be 6.8, it would be 10.1 if you actually used what rents increased on an annual basis looking back. So inflation's certainly here, and it's probably a little bit higher than what the CPI number is.
This is one of those other things you hear a lot of comparisons to the 1970s inflation when they weren't necessarily using kind of the same basket or the way they're counting inflation. So it's not really a fair comparison when you're looking back, because we're probably understating inflation right now.
I would say that all the changes to the CPI have always continued to understate what it is. Now, that's not to say that there isn't a reason to do it. It's a term called hedonics. I just like saying the word. But it's really measuring substitutes and also considering how more powerful a computer or something is. What can you do with it? And those things are real. If you're buying wooden ladders and all of a sudden wood goes up and you switch to aluminum or vice versa, those substitutes are decisions people are making. And then your computer, it is certainly far more powerful than it was in the 1990s. But how do you actually account for that? Do you buy a TV regularly? What's the basket weighting? What is all this? And whenever you actually look at what are the changes and ask yourself, does it bias upward or downward? It should, if we're just randomly selecting these, basically go both ways, but it almost always biases down. And that gets the inner cynic of me whenever I see something like this in the BLS, where they're saying, hey, we're going to update the weights, and we have the Fed and others talking about how inflation needs to come down. Well, this is certainly a way to bring inflation down.
Easiest way.
Easiest way, yes. We will still feel high inflation, but know that the weights are being changed. We will take a look at this and find out what's going on, because we want to have an understanding. And it's not just the consumer price index for inflation. We're starting to see that in producer prices as well, which could cause prices to move up. If they can push that out on the consumer, we'll see it over in the CPI. If they can't, profit margins are probably going to have to be squeezed on businesses. And all of this to be said, we had Arends with Arends and PIMCO. These guys know inflation. They know what's going on with bonds and fixed income, because fixed income is so susceptible to inflation. He was on Face the Nation here recently. We're basically saying the Fed has to act. Otherwise, they're going to lose credibility. And even whenever they were to act to try to get inflation under wraps, that actually could increase inflation just because they have lost their credibility on that.
So that really gets to what does acting look like.
Right.
And short-term, tapering of asset purchases. So they've been buying 120 billion a month since March 2020, recently reduced it to 90 billion, and now the talk is that going down? We're looking at Goldman Sachs here, and they say they think it's going to reduce to 30 a month, basically saying there's only 100 billion left in asset purchases. If they tapered at 15 billion like they're doing now, it'd be 200 billion. So what's the difference of 100 billion? It's really not that big of a deal to the market, but it signals that the Fed is going to start raising rates sooner than later.
And this is not the most severe or the fastest that I've actually seen. I've seen Morgan Stanley had 5 rate hikes scheduled. But I think this is a good thing to kind of look off of and see what we expect. In the market, as of this morning, was pricing in a taper and reduction. Now we'll read the minutes. They're being released. They were released at 1:30 today. We want to get in there and not just go off of headlines on what was said.
If you go back, also laying out what Goldman thinks for rate hikes, they're seeing 3 of them next year, staggering them through their meetings starting in May. I know we're coming out with our 2022 outlook in a couple weeks here. I think we're pretty close to this. Consensus is 2 to 3. So some people are out there with 5, but staggering the rate increases to 75 bips or so by the end of the year looks to be consensus.
And I would say the big question then is, what impact is this going to have on the market? Because if they are tapering, especially if they're tapering quickly, we could see a pullback. And actually, I would say we expect to see a pullback sometime next year, could even be as early next year. But I wanted to pull out, going back to 2009, we had an average intra-year decline of negative 14%, with 2020 being down 34%. I think we can all remember that. But then let's look over, what is the average return in those years? 13%. There was only 2 years where we had a negative return. 2015, negative 1%, and then we have 2018 at negative 6%. So though we would expect some volatility and probably some downside action in the market, it's probably going to be very short term, especially if the Fed has raised rates. Then bad news becomes good news for the market, because then they're going to anticipate they're actually going to lower them again. All this means is that inflation is, though it may slow because of the Fed beginning to raise rates, if we see a market pull back, then we're probably going to see an accommodative Fed again. And if they don't, that means that the market is moving up, and then we're late cycle, we tend to see inflation there. So I would say inflation risk is still high. Now we'll be monitoring the market for any downside action. I know you're wanting to say something.
I was just going to say, just to back up in case we have a new viewer, can you explain why rate increases by the Fed is a bad thing for the stock market or a bad thing for the economy?
Well, when the Fed is accommodative and it's creating money, that money hits capital markets first. And it looks to go in either the bond market or the stock market, but it all makes it into the stock market and pushes prices up. That's actually the reason the Fed is actually becoming accommodative, right? We had a correction. The market valuations are decreasing. They want to add stimulus, so then they create additional money, which then puts some purchasing power within the capital markets, and that pushes stock prices up. So if that's the case, if the Fed is starting to pull back some of their tapering, or raise interest rates, essentially what they're saying is they're not going to provide as much liquidity for the market, meaning that there's a slower growth in the amount of money being put into the economy from the central banks. That tends to pull back. One of the things that we watch for that is the yield curve, which is the short end of the curve. These are deposits that you're putting in your bank and what you're getting paid on, versus the long end of the curve. This is what you're borrowing for mortgages. And if you can borrow at a rate higher than what you're getting paid on a deposit, banks are eager to create money as well. So they will make loans to capture, let's say, that 3% on a mortgage to pay out 10 basis points on short-term deposits. Well, if that turns the other way, where your deposits you owe 4% and you're only getting 3% on long-term debt, that causes a problem. They don't make loans because you can't make up, if you have a loss on every deal that you make, you can't make up the amount through volume, right? So then they slow and we see a contraction. So we're going to pay a lot of attention to this yield curve to understand what is the liquidity in the market. Is the short-term bond market actually higher than the long-term bond market? That would say that we're probably going to have a correction. It's been 100% whenever we look at this. I will say the caveat is I wouldn't have expected a 2020 correction if it wasn't for COVID, even though that this was signaling it. So it could have been a false signal there, but it still rang true. And all of this is really controlled by the money supply, as you were mentioning, which is another component. We are seeing the money supply begin to pick up. It takes a little bit for it to make its way into the market. We did have a slowdown from weeks 25 all the way out to week 40, but we're now picking back up, and this is one of the reasons that we think a Santa Claus rally is actually to be expected. Another reason not to be too concerned about a correction, not just the amount of time we think it would be here and pass pretty quickly, but there's a lot of cash on the sidelines. If we just go back to January 2019 and we look at what are the fund flows for cash accounts, bond accounts, and stock accounts, we can see a lot of cash has moved onto the sidelines into investment accounts.
Too. It's hard. It's kind of hard to see because it's a couple-year chart. But recently, cash is coming up, probably from some equity outflows that we've been seeing. But is that one of the reasons you think Santa Claus rally and maybe January effects, that they're locking in gains for 2021 to redeploy? Yes.
So we've had $223 billion over just the last 7 weeks go to cash. A lot of this is, I think, that window dressing that we talked about. And this means if we do have a correction or a pullback in the market, there's plenty of, I think it's $4.2 trillion sitting on the sideline looking for a place to go. And what do we know that's going to happen here at the year end? Not just mutual funds and ETFs and others deploying capital, but many of the retail clients are going to be meeting with their wealth advisors. And we just talked about, or started out with, inflation at 6.8%. They're going to have high cash balances. They're going to say, hey, we need to get this in. Why? Because fixed income's already losing money. We're going to get to that return here in a little bit. Plus, you're losing it on purchasing power as well. So that money is going to get deployed. So I don't think we're going to have a deep, long correction, but I would expect one sometime over the next half as the way things are going. So do you want to mention any the breadth that we had talked about?
That's probably the other big headline is market breadth, which is just measuring stocks that are up versus stocks that are down. And there are very few stocks that are up, and there's a lot of stocks that are down right now.
If you were to look at Microsoft, Google, Apple, and you take those out, the S&P 500 is certainly getting close to correction territory. So those big names are certainly holding it up. It's not the first time that's happened. And with the money supply and the amount of cash, we're not too concerned about it at the moment. Well, once again, we do see the possibility of a correction. If we do that, we will be taking advantage of it. Also, as we progress and if we start making new highs, we'll likely start to raise some cash ourselves despite the inflation, because we do have that equity overweight relative to your risk profile questionnaire. Any other comments that we want to talk about? All right, well, we appreciate you listening. If you haven't subscribed already, make sure you click below. And if any friends would benefit from hearing this, hit that arrow button and share it with your friends. And you can't dislike us anymore. I think YouTube took the dislike button. So make sure you hit that like button. And we appreciate it. We'll see you. Will we see them next week?
Yes.
We will see you next week. No?
No.
Jess is saying no. We won't see you next week.
Not next week.
So is that, I thought we were off.
We'll figure it out.
We'll figure it out. If we see you next week, we're excited to see you. If not, we'll see you at the beginning of the year with a 2022 outlook and how we did for 2021. Thank you.